And now I would like to introduce our moderator this evening, Professor Marie Antrodogi, chair of both the UW and the Jackson School of Japan Studies programs. Dr. Antrodogi is a professor in the Henry M. Jackson School of International Studies and specializes in the political economy of Japan. She received her undergraduate, master's, and PhD degrees from the University of California, Berkeley. She currently holds the George Long Endowed Professorship as well. Her research is focused primarily on the key institutions and policies of Japan's capitalist systems, and she's currently researching the political economy of entrepreneurship, venture capital, and high-tech startups in Japan. Her teaching and numerous publications reflect deep understanding and broad knowledge of the policies and institutions of Japan's political economic landscape. Please join me in welcoming Professor Antrodogi.
Thank you very much, Ellen, and thank you all for coming here tonight and also in the morning in Tokyo. It's a great honor to introduce Professor Takeo Hoshi of the University of Tokyo's Economics Department, where he just completed a term as dean. Before returning to Tokyo, Professor Hoshi spent about 25 years in academia in the United States. He was first Pacific Economic Cooperation Professor in International Economic Relations at UC San Diego, and then Henry and Tomoye Takahashi Senior Fellow at the Freeman Spogli Institute for International Studies at Stanford. He has written numerous sole and co-authored articles about the Japanese economy. I'll just mention a few. Recently, Zombies Again, the COVID-19 business support programs in Japan, came out in the Journal of Banking and Finance. Before that, Will the US and Europe Avoid a Lost Decade? Lessons from Japan's post-crisis experience in the IMF Economic Review, and Zombie Lending and Depressed Restructuring in Japan in American Economic Review. He's also written several books, including The Japanese Economy, co-written with Takatoshi Ito, The Political Economy of the Abe Administration and Abenomics Reform, which was co-edited with Philip Lipsey, and Corporate Financing and Governance in Japan, The Road to the Future, co-authored with economist Anil Kashyap, and this book received the Nikkei Award in 2002 for the best economics book. Professor Hoshi is also co-chairman of the academic board of the Center for Industrial Development and Environmental Governance at Tsinghua University in China, and senior fellow at the Asian Bureau of Finance and Economic Research, which is based in Singapore. He also served as director of the Union Bankal, chair of the board of Tokyo Foundation, and director of the Japan Investment Corporation. He's received many awards, including the 2015 Japanese Bankers Academic Research Promotion Foundation Award, a 2011 Reischauer International Education Award from the Japan Society, a 2006 Enjoji Jiro Memorial Prize from Nihon Keizai Shimbun, and 2005, he received the Nakahara Prize from the Japan Economic Association. Professor Hoshi received his bachelor's degree from the University of Tokyo and the PhD in economics from MIT. We are very lucky to have Professor Hoshi with us tonight. He's one of the very few economists I know that can really talk to general audiences and put things into more simple language. So please join me in welcoming Professor Hoshi to the University of Washington for a talk about key challenges to the Japanese economy. Thanks for coming.
Thank you, Mary, Professor Antrodogi, for a very kind introduction. And it's my pleasure to talk with you today between Seattle and Tokyo. So good evening and good afternoon, everybody. Let me start by sharing the slide I prepared. And how am I doing with the slide? Does this look okay? Good, good.
Yeah,
okay.
looks good.
So I'd like to talk about what the topic I prepared is titled Key Challenges to the Japanese Economy, and I regret to have so wide a topic. There are lots of challenges to the Japanese economy, and nobody can cover all of these in 50 minutes. So I decided not to talk about the many key challenges, but focus on just two. Okay. And one is low economic growth in the last 30 years or so after the bubble burst at the end of 1980s or the beginning of 1990s. And then also mild but persistent deflation that continued at the same time with low economic growth for 20 to 30 years. And the focus of my talk today will be monetary policy, which are important in explaining both. That doesn't fully explain economic stagnation in Japan, but it has the monetary policy has been an important part of the problems for Japanese economic growth and also a persistent deflation. So I will be focusing on monetary policy today. And this is great timing to focus on monetary policy because the Bank of Japan just changed the governor. The governor Kuroda was the governor of the Bank of Japan from 2012 to 2012 or 2013? 2013 to 2023. And he stepped down just about a month ago and taken over by Professor Kazuo Ueda, who was a professor at the University of Tokyo and also another university in Tokyo. But more importantly, he's an academic economist. And this is the first time the BOJ is headed by an academic economist, MIT PhD, 10 years ahead of me. So this is a good timing to talk about the Japanese monetary policy and how it has been changing and what kind of challenges the Japanese monetary policy and the BOJ faces today. And we can speculate where the Bank of Japan is moving to and what will happen to the Japanese economy. And let me start by promoting a book of mine, well, one of the books Mary mentioned. This is a textbook on the Japanese economy that I did with Takatoshi Ito. And the English version or the original version came out 3 years ago, 2020. But now the Chinese translation was published late last year. And now the Japanese version, Japanese translation, was published in March, a couple of months ago, just in time for the new academic year in Japan. So this textbook covers many challenges that the Japanese economy faces that I can't talk about today. So if you're seriously interested in knowing more about the Japanese economy, I highly recommend this book. And this book was published, well, we finished this book 3 years ago, before the COVID started. So it's already a little bit out of date, but MIT Press tells us that they want to see a little bit more sales before they let us work on the third edition. So if you can help me on that as well. Okay. So coming back to today's topic, I will be focusing on economic stagnation of Japan that many of you have heard, and the lack of inflation or deflationary pressure that the Japanese economy experienced in most of those low stagnation periods. And this first slide was taken from my book with Taka, figure 3.2 of the Japanese economy. And this shows Japanese growth rate, real growth rate of the Japanese economy from 1955 to 2015. So this is a quick review of what happened in the Japanese economy in the last half a century, a little bit more than a half a century. From 1955 to 1970, you can see the green line there, which is around 10% of, can I use this? Okay. The 10% or a little bit below 10% a year annual growth. And it was a period of rapid economic growth, which some of you have heard. And then in the mid-1970s, the Japanese economy slowed down to around 4% growth and stayed there until the end of 1980s. And back then, so this was the time I started studying the Japanese economy and economics in general. And we talked about why the Japanese economy stopped growing and growth slowed down. But then after the bubble burst in 1990s on, the Japanese economy, the growth rate of the Japanese economy dropped even further, down to very close to zero, and stayed there for 30 years or so. Okay. And this is another way to see the picture of the so-called lost 2 decades or 3 decades, depending on where you start. Green line shows the log level of GDP. So it was growing in 1980s, but after the mid-1990s, so there was a bubble period, but after mid-1990s, the economic growth slowed down. So the GDP becomes flatter. And this red line shows the trend line of the log GDP from 1980 to 1996. So if the Japanese economy grew at the constant rate, at the same rate as the 1980 to 1996, the Japanese economy would have followed this red line, which it didn't. So this shows a stagnation of the Japanese economy compared with what many people expected the Japanese economy to grow back in the 1980s. So this period after 1990s is called lost 2 decades or 3 decades. Okay. And at the same time, Japan experienced falling price level or deflation. Okay, and this shows inflation rate measured by a subtle CPI inflation rate, and blue line is a headline CPI, which includes all the goods, and green line excludes the fresh food and energy, and this is what the BOJ focuses on currently. And either inflation rate, regardless of which inflation rate you look at, we see often, so this starts in 2006 and goes to today, but often we see the experience of a deflation. So this is around 2010. Deflation rate was mostly mild, around 1%, but nonetheless, it was persistent. I forgot to put all your numbers to this, but the deflation really started around 1995 and continued to almost today. Okay, and the things may be changing right now, which I will come back to, and that will be a focus of today's talk. Okay, so why Japan experienced long time of economic stagnation and deflation? And the simplest way to understand this is to use a framework in simple macroeconomics, which talks about aggregate demand and aggregate supply. So the idea here is the economy can grow or economy can stagnate because of 2 potential reasons. There may be not enough demand, or there may not be enough supply, or even though there is plenty of demand, but the capacity for the economy to produce may be constrained. So for those, or economy can have a problem on both sides, the demand and supply. And one of the key to understand which one is more responsible, the demand side or supply side, is to look at what's happening in inflation or the price level. And roughly speaking, and also we could come up with a more detailed model, but intuitively, we can understand why looking at the price level or the inflation can help us tell which one is a problem, demand side or supply side. If the demand side is a problem, if the demand shortage is a problem, what we see will be that the price cannot go up. Even though there are lots of goods, there is a shortage of demand, so the price level stay the same or even fall. On the other hand, if the supply side is a problem, and if there is a healthy demand, we would observe inflation. And what we observed for Japan is, of course, deflation. So that suggests the demand side was more important than the supply side. But at the same time, we didn't observe the deflation getting more serious and more serious and serious over time. What we saw was a persistent but mild level of deflation. And this is something we wouldn't expect if the demand shortage was the only problem and the supply side or the production capacity of the economy continued to grow. If the supply side or the production capacity of the economy continued to grow and the demand stagnate, what we would have observed is not the mild deflation, but the deflation spiral, the deflation rate becoming lower and lower or higher and higher, which wasn't the case for Japan. So what the Japanese case tells us, or most of the economists, is that there was a problem on both demand side and supply side. So the policy, if we needed to get out, if we wanted to get out of stagnation and deflation, the policy needed to work on both demand side and supply side. And in a sense, this is what Abenomics tried to do. If you have been around, or if you have been looking at the Japanese economy for more than 10 years, you remember Abenomics. And you remember 3 arrows, okay, which was a bold monetary policy, expansionary monetary policy, flexible fiscal policy, and a growth strategy to promote private sector investment. And the first 2 try to address the demand side, demand shortage, and the third one try to address the supply side. So what really happened in Japan, or what happened in Japan, is not so much the supply side continued to grow following this red line and the demand stagnated at the blue line. It's more like this brown line was the supply capacity. So the supply capacity, so the demand stagnated, and that was more important than the supply side, as suggested by deflation, but the supply side economy also suffered as well. So in order to recover the growth, the Japanese economy or the policy should have focused on both sides. And so from that point of view, Abenomics, I guess, was in the right direction. And Abenomics succeeded in a sense, or at least tried to stimulate the economy, and showed reasonable success in fixing the demand shortage. I don't have the figures here, but we can see the output gap shrank. That is compared to the production capacity, the economy's actual output started to be very close. the unemployment rate fell and the labor market got very tight. And the deflation also, as we have seen in all your graphs, in the Abenomics period, the deflation was, or inflation rate was mostly low, but in positive region. Okay, we can ignore this increase in inflation in 2014 because that happened because of the consumption tax increase of 3%. Okay, but there was a puzzle, okay. And deflation may have ended, but the inflation rate never reached the 2% target that the Abenomics and the Kuroda BOJ stated. And this was the case even with a massive monetary stimulus. I just increased the font size of massive to show this was really large. And despite shrinking output gap and tightening labor market and massive monetary stimulus, prices nor wages increased. So Japan seems to have been in a sense, wage price spiral, but the spiral that never goes up. So it's like a wage price circle. Because the prices do not rise, the firms cannot raise wages. But that's okay with workers because prices do not rise. So they can be content without wage increases. So the firms do not have to increase prices, and the circle continues. So the question is, or question for a naive economist is, why? Even with a tight labor market, unemployment rate is low, and many companies complain that they can't find the workers. Why the wages did not increase, and why the prices, or why the firms were not pressured to increase their prices. And many people ask this question, but well, let me skip this. This slide just shows how massive the monetary expansion was. So many people ask this question, why the wages and the prices did not rise even with the tight labor market. And I asked that question with annual cash app 2, and this is in the result appeared as a chapter in the book on Abenomics that I edited with Philip Lipsy, as very kindly introduced. And this is not just our idea. These ideas have been suggested by many economists in Japan, especially labor economists, including Yuji Genda, who's a very good labor economist, a colleague of mine at the University of Tokyo. But the key we focus on is the dual labor market nature of the Japanese economy. And some of you may have heard about the distinction between regular workers and regular workers and non-regular workers, or full-time workers and part-time workers. I don't get into the fine distinction between regular versus full-time and non-regular versus part-time. And I use those words interchangeably. But the key explanation is this. There are several factors, or the two factors, which made the Japanese wages less sensitive to the labor market condition. And one is the excess or excessiveness or excessive regular workers. And after the banking crisis in Japan, many Japanese firms got into trouble, but they couldn't get rid of old workers or the workers on lifetime employment, regular workers. So they started to express that they feel they have excess workers. So that made their wages of regular workers disconnected from the labor market condition. Even though the labor market is tight, the labor market inside a firm for regular workers wasn't tight. And at the same time, the Japanese firms increased the proportion of non-regular workers. They can't get rid of the regular workers, so they didn't want to hire regular workers, and instead, when they hire new workers, they hired as part-time workers. The wages for those non-regular workers as part-time workers responded to labor market conditions. This is something we can see and we show in our paper. But the level of wages for part-time workers were much lower, and still are, much lower than those for full-time workers. So even if we see an increase in part-time workers' wages, if the proportion of full-time workers who earn higher wages decline, over time, we tend to observe a lower average wage level because we have more part-time workers who earn less, much less than the full-time workers, even if the low wages of part-time workers increase a little bit because of the tight labor market. So these two factors, excessive regular workers and also increasing proportion of part-time workers, prevented the average wage from rising, even with the tight economy, tight labor market, and massive monetary stimulus. And also, we show a relation between wage inflation and the price inflation also got weaker, but I don't get into the details there. So, but in 2022 and 2023, the things may be changing. As many economies around the world, including Japan, are recovering from the COVID-19 recession, the inflation seems to be coming back, even in Japan. So the left side of this graph, the graph on the left shows the inflation rate, CPI inflation rate for 4 major economic areas, Japan, EU, UK, and the US. And as we know, in the US and the UK and also in the EU, inflation has been increasing a lot. It may have been stabilized a little bit, especially in the US. And Japan was late, but the inflation rate is coming up. Okay. And to respond to this, the many central banks, including the Federal Reserve, or led by the Federal Reserve, has been raising interest rates. And this is something the Federal Reserve just did this week too. But so far, the monetary policy hasn't changed for Japan. So inflation seems to be coming back even in Japan. So the long period of deflation or Japanese type of wage price spiral, the zero wage inflation promotes zero price inflation, vice versa, seems to be or may be ending. And if that's the case, eventually the BOJ may have to be pressured to increase the interest rate in order to prevent inflation from getting even higher. So it's around 4% or 3% if you look at the core inflation rate, excluding fresh food and energy price. As I said, the Bank of Japan changed the governor, and the new governor, Kazuo Ueda, under the new governor, the BOJ just met last week, and they decided they decided on the monetary policy. And some people expected, or many people was curious what Governor Ueda and the new BOJ would do during the first monetary policy meeting. The result was that they decided not to really change the monetary policy from an earlier regime. So they decided to continue quantitative and qualitative monetary easing. That's a name for the monetary policy stance with yield curve control. So the following the QQE policy, they continue to expand the monetary base until the CPI inflation rate exceeds 2% and stays above that target in a stable manner. As we saw earlier, and some people may have noticed, the Japanese CPI inflation rate for all items less fresh food is already exceeding 2%. Okay, but the BOJ thinks, or the BOJ's official position is if it's not staying, or if it's not expected to stay above the target in a stable manner. So they continue QQE at this point. They continue to expand the monetary base. Also, they set the interest rate, short-term interest rate, to be negative. So they charge a negative interest rate on some of the deposit that the commercial banks have at the Bank of Japan. So they want to give an incentive for the commercial banks not to hold on to a lot of money or lot of funds. And at the same time, they also want to hold down the long-term interest rate as well in order to stimulate the economy. And this is so the YCC consists of two things. They hold the short-term interest rate low, and they also hold long-term interest rate at some level, and continue to pressure down the yield curve. So that's what it's called, yield curve control. And they continue to limit 10-year JGB yields, the interest rate, 10-year interest rate on 10-year government bonds, around 0%, plus minus 0.5 percentage points. So they allow the interest rate, long-term interest rate, to fluctuate a little bit by the market forces, but not too much. This range, plus minus 0.5 percentage point, used to be 0.25% until the end of last year, 2022, and the BOJ just changed at the end of last year to expand the range of 10-year JGB yields. So many people thought that was the start of a change in YCC, but this time the BOJ didn't change or didn't increase the range as some people suspected. And the BOJ continued to purchase assets and make the BOJ balance sheet bigger. So this is something Federal Reserve did when they were expanding the monetary policy following the global financial crisis and also global financial crisis until the economy recovered. Bank of Japan still continues this expansionary monetary policy by buying up many assets. Okay. Now, as I said, the many countries have been raising the interest rate But BOJ has been continuing the expansionary monetary policy, even though the Japanese economy seems to be experiencing inflation as well, although the inflation rate so far has not been as high as the inflation rate in the US or in Europe. So the BOJ is in a difficult situation on how to continue. So far, the BOJ is continuing the very expansionary monetary policy, but there is a risk of doing that as well. So from the BOJ point of view, they want to avoid two extreme possibilities. The one is there is a risk of continuing extraordinarily expansionary monetary policy, which is the current policy, setting the negative interest rate and holding the long-term interest rate to around 0%. Well, of course, the possibility or the risk of following that, the continuing that policy, even when the inflation rate started to come up, is the inflation rate goes even higher. And this is something we already seeing, that because the BOJ has been setting the interest rate low compared with other countries, the yen depreciated. But eventually, if the inflation continues to go up, the BOJ eventually will need to tighten monetary policy drastically. And in a sense, this is what the Federal Reserve had to do last year, and eventually create recession or instability in the financial system, in the banking system, which is the U.S. is experiencing now. So there is a danger of a too late normalization. But on the other hand, Bank of Japan thinks there is a risk on the other side as well. The other side is raising interest rate or exiting from unconventional monetary policy or extraordinary expansionary monetary policy too soon. And in a sense, the BOJ has a track record of doing this. I don't get into the detail today, but you can read our textbook. In August of 2000, Bank of Japan, back then, the Bank of Japan was already doing a zero interest rate policy. They deviated or they terminated the zero interest rate policy a little bit because they thought the economy was recovering, but the economy got back into recession after that, and the Bank of Japan had to go back to zero interest rate policy and quantitative easing. 2006, this is more debatable. The Bank of Japan stopped the quantitative easing in 2006. Some people think that was the right timing. Some other people, including myself, think that was that was also premature, and Japanese economy got into a recession again. And of course, 2008 or 2007, 2008 was the start of global financial crisis. So it's hard to tell how much the monetary policy decision was responsible for the downturn in 2008, 2009. So there is a danger. The BOJ feels that if they stop the extraordinary expansionary monetary policy now, the economy can get back into stagnation and even deflation. So there is a danger of too early normalization. There is, of course, a possibility for the BOJ to get this right. Okay, so continue the extraordinary expansionary monetary policy for now, but exit from that or normalize at the right moment so that the economy reaches the 2% inflation target and the economy continues to grow. That seems to be, if you look at the report of the BOJ, so this is an outlook for economic activity and prices that the BOJ published at the same time they decided on the current monetary policy in April, last week. This shows the inflation rate, expected inflation rate of CPI, all items less fresh food, according to the BOJ policy board members. So these each point represents a policy, the inflation expectation by a policy board member. Okay, the point estimate. And if you look at the point estimate, they're expecting, so in 2022, as we saw, the actual inflation rate was above 2%, but they're expecting the inflation to come back to around 2%. Okay, so in that sense, the BOJ seems to be thinking that they get this, they can get this exactly right, and the economy can converge in 2% inflation rate, which is their target. Okay, but in a sense, this this figure can be misleading in the sense that this doesn't represent risk assessment of policy board members very much. There's actually, they try to show this by using a white triangle and a black triangle, which is probably too small to see on your screen, so I don't get into that. That is, if you look at more details of the explanation of this report, they can see the many BOJ board members and the BOJ sees there is a substantial possibility that the inflation can actually go up there or come down here. Okay. So these are point estimate of a 2% inflation is not tight in that sense. And this is actually, or this is what the BOJ actually said. The BOJ, or concerning risk to the outlook, there are extremely high uncertainty. And going down to another place that I bolded, risks to prices are skewed to the upside for fiscal 2023. So they worry more about too high inflation in 2023, but skewed to the downside for fiscal 2025. But eventually, they put more weight on low inflation scenario. So seemingly consistent with our record, Japan, unlike other countries, had a hard time achieving inflation, hard time getting far away from a deflationary period. So it's understandable, it seems understandable that the BOJ worry more about the downside and, in a sense, less about the upside, or it's not quite upside, but the high inflation possibility. Okay. But the one thing we need to think about is the Japanese labor market seems to be already changing, and Japanese wages seems to be now responding more to the labor market condition. Okay. Unlike what was the case in 2000 or 1990s. And we can see this by looking at one factor that tends to reduce the wages in Japan, that is increasing number or increasing proportion of the part-time workers. And this is proportion of part-time workers for every year from 1990 to 2022. And as we can see, the part-time workers, the proportion of part-time workers increased over time. But after the mid-2010, actually, this ratio has stabilized. So if both the part-time workers' wage and full-time workers' wage start to increase, the average wage would also increase as well. Okay, so it's more likely the wages can respond to economic condition. And the other thing is this is proportion. This is a measure of excessness of the full-time workers or regular workers. And I forgot to change Japanese into English, but red line is for regular workers, and blue line, or red line is for normal workers, which is pretty close to regular workers, and the blue line is for regular workers. That doesn't matter anyway. And this is a proportion of companies which says they have excess workers, and that tend to be quite high. It fluctuates, but tend to be high from the 1990s to mid-2010. But the excessness of the full-time workers seems to have disappeared in mid-2000. Okay. And it went up a little bit during the COVID crisis. But the interesting thing is in COVID, the excessiveness of the workers increased, or excessive workers increased for both full-time workers and part-time workers. So if we look at the difference between the excessiveness of the full-time workers and part-time workers, then we don't see any difference between full-time workers and part-time workers. And before that, the phenomenon of excessive workers only applied for full-time workers. So the things are changing. And already the wages have been rising even before the COVID, if you look at the average wage. And I guess this figure is easier to see. So this shows a wage for full-time workers and part-time workers separately. And the average is a blue line. And the average wage and full-time workers' wage is measured on the left-hand side. And the part-time workers' wages are measured on the right axis. Okay, so the numbers are much lower for the part-time workers than the full-time workers. And this is in nominal terms. So what this shows is average wage in nominal terms didn't change for 15 years or so. Part-time workers' wage increased over time, and the full-time, because of, and this is because the constant wage was there because the full-time workers' wage didn't grow. And as I said, the proportion of part-time workers increased. So the average wage kept low. But that started to increase starting right before the COVID. So it's possible. So there have been an important changes in the labor market. And so the average wages are likely to rise when the labor market is high. So it's possible that BOJ, or the Japanese economy, is going to, or there is a danger that the Japanese economy experiences too high inflation rather than too low inflation. And one of the key things to look at is what's going on in the annual wage negotiation between labor unions in Japan and the management, called Shunto, or spring wage negotiation. And there is a mention of that in the BOJ report, but this figure is probably easier to look at. This is taken from Rengo's press release. Rengo is Association of the Labor Unions in Japan. And this shows the wage increase of spring wage negotiation for average worker and the workers and SMEs separately. And it doesn't matter which one you look at. And the numbers is for the June every year, except for this year's number, which is in April. So this number is much higher than the wage increase in the last 20 years. And in fact, we are experiencing or we are observing the largest wage increase in 30 years. So the wages seems to be, wages are picking up. And this can create a different type of wage price dynamics in Japan. So there is a danger that wage increase continues, which fuels the price increase, and that leads to a higher wage increase and create a higher inflation than 2%. So it's a judgment call, but the BOJ thinks the low inflation scenario is something, the risk of too low inflation is something we need to worry about more for Japan. So they decided to continue the current expansionary monetary policy. But the change in the labor market and also that is observed and what's been happening with Shunto this year would make someone worry more about high inflation or too high inflation in Japan. And or the Japan may go back to, or the Japan may converge to just the right level of inflation of a 2% target. Either way, if we can, if Japan doesn't go back to a low inflation or a deflationary period, then eventually the BOJ have to raise the interest rate. It may happen orderly in orderly normalization, or it may be pressure to increase the interest rate much faster than they thought, as the Federal Reserve had to do last year. So, but either case, the normalization of monetary policy, which means higher interest rate than zero or negative, will happen sooner or later. And then the important thing for the Japanese economy, which includes the BOJ and also the government, is to make sure when the Bank of Japan has to raise the interest rate, has to normalize the monetary policy, they have to, or they want to make sure some instability in the financial system doesn't happen. And here, one thing we really need to worry about is the situation in the government debt market. And the many people, including myself, have been worrying about the sustainability of the Japanese government debt for a long time. And so far, there haven't been any problem. The Japan continued to issue increase the amount of government debt. And Japan just did that. Japan did that in the COVID to respond to the pandemic, which is what many countries did. And also, this is again what many countries are doing. But Japan again decided to expand the government expenditure, especially in the area of defense. green transformation, and also they talk about the policies to increase the birth rate in Japan. So the sustainability or the unsustainability of the government debt will emerge as one of the most serious concerns if the Bank of Japan has to raise the interest rates in the near future. So let me end by looking at how the interest rate is related to the government debt or sustainability of the government debt. So on the left side of the graph, this shows the government forecast of the government debt to GDP ratio according to the government calculation, and this shows the timing of the projection. So in 2012, 2014, and back in 2012, we worry about the government debt increase a lot, and this shows back in 2012, in the baseline case, if the growth didn't recover, the Japanese government was expecting exploding the government debt. But over time, the prediction of the government debt looked more benign, and the only reason is they were able to adjust the path of interest rate, so which is shown on the right-hand side. They have been adjusting the path for the future interest rate down, reflecting the declining interest rate in the market. But the things started to change or maybe the things are changing in 2012. So from 2018 to 2012, the interest rate projection continues to go down. But in 2023, so this is a January projection compared with the July projection of the last year, the government had to raise the interest rate. Okay, but still, it's much lower than what they expected in 2018, and only considers interest rate increases to a little bit less than 1% by as of 2032. So if the interest rate got much higher than this, the government debt sustainability will become a problem. And even with a relatively low interest rate, relatively small interest rate increase, in the baseline case, the government debt is marginally sustainable. It starts to increase a little bit. So with a higher interest rate of, say, even 2%, there will be a serious danger. So that's another thing the BOJ need to worry about. So wrapping up, Japan suffered from deflation for a long time, but the situation seems to be changing, and Japan faces two-side risk: the risk of too high inflation and the risk of too low inflation again. And the BOJ seems to put more weight on low inflation scenario and wants to continue the expansion of, or continue expansionary monetary policy, but we probably need to worry about the high inflation scenario as well. And in that case, we really need to worry about the government debt situation in Japan. So let me stop here, and I guess there are some questions.
Well, thank you very much, Takeo. All of you, please start putting questions in the box. I wanted to ask you if you could talk a little bit